Hey Chip, how's it going?
Hey, how are you? Thanks for
Very,
having us,
very,
Al.
very good. Thank you for taking the time to be on the Distro Boss podcast. This is Distro. In this instance, you're the boss. You're the guy who's experienced in raising capital and deal making. I'm really trying to have conversations about that deal making and raising
Sure,
capital. And you've got like 30 years of experience in real estate, from managing over $200 million in real estate at one point to raising money on PPMs, deal making in general, raising capital in general. I think that we can, bounce around some of these topics, have a conversation about what makes a good deal, the trials and tribulations of raising capital. Where do you raise it from? People or institutions? Is it debt? Is it private investors? That we can just sort of chop it up, talk about what makes
sure,
a deal, and what it takes to get investors.
sure. Well, so let's sort of start with what makes a deal, right? And
Yeah.
I will always tell people, it's like, look, what do you bet on, right? Because as an investor, you're looking at a project. First thing you're looking for is capital preservation. Look, we're all here to make money. That's the goal. But the first rule is don't lose money, right?
Right.
So you want to make sure
I feel
that
like isn't that a Warren Buffett statement? Like, don't. First rule is don't lose money. Second rule is don't forget rule number one. Right? Something like that.
It's exactly correct. It's
Yeah.
exactly correct. So here's what I've learned over the years, right? You can have an average project, but with an excellent sponsor, meaning somebody that you can count on, somebody that knows what they're doing, somebody that has attention to detail, somebody that your goals are aligned with, right?
Mhm.
In every case, those deals work out. Okay. And then you can have a deal that has unbelievable margin. The profits are fantastic. All that stuff is there. But you have a borrower that either isn't qualified to do what they're supposed to do or they get over their skis, right? In every case,
And
you
I've been
might get
part of
your
one of
money
those
back,
scenarios before.
right? In every case, you might get your money back, but it's hard. It's a hard road to hoe. You come back at the end of that and it was like, okay, which experience could I grow from? Which experience could I scale? And the answer is if you're with somebody that you can count on, well, you don't necessarily have to babysit them. You don't have to micromanage. You don't have to be on top of every little thing that they're doing because you know that they know, right? So it's really, you know, people have two different schools. I want to invest into a deal, or I want to invest into a person, or a project, or a company, or a bunch of individuals. My overarching experience has been: if you bet on the right people, it always works out. If you're betting on projects, sometimes it doesn't work out. You know,
Absolutely. I absolutely believe. I I feel like I have to share a story I wasn't planning on sharing on this episode, on this podcast.
please do.
Um, no, I absolutely 100% think that you are correct, because it has to go beyond just the project itself. The project itself can look great on paper. It could
Yeah,
be asset backed. It could have all the right trimmings. It could have the right contracts in place. It could have the right exit clauses in there for the investor, the exit options. It could have everything, but if it's not run by the right captain, it could all fall to hell.
right.
And I've raised money for a long time, for a lot of years, and this is me coming to a story. A story. I I've raised money for businesses that, for the most part, based on their project, it looks good and it ends up being good for the most part,
Right.
or at least decent. Investors get what they wanted in the end. Sometimes it was a rocky road, but it worked out in the end. But then I had this one instance which completely pulled the rug out under my feet, where a company that I was raising money for, the owner of that company decided, sort of a quarter way through the project, he had like plenty of locations that they were building, decides to run off with the money.
Yeah.
We don't even understand why, because it was a good looking business. It was growing, it was scaling.
Right. Right.
At the time, it was a co-working business called Barworks. Around 2015, WeWork was all
Right.
the rave.
Yep.
Everyone was looking at that as the next thing with commercial office space. It was all going to be co-working, and then this guy comes around with an idea called Barworks, which was this street-facing retail option, which is
Right.
turning restaurants and bars in
Right.
really
Right.
prime locations. Because when
Right.
you look at a prime location, you have like the top tier restaurant, a couple of lagging behind, and then you have like the fifth or sixth restaurant down the street that's kind of like they've got like a a revolving door in terms of tenants. They kind of always have to chop and change, right? That would be the location that he'd pick. So it'd still be like a high footfall location in a very dense area of the city. And he could open up 4 or 5 of these locations inside of a few months in any given city. And he did this in the US, and it was a very good idea. Okay. And he could turn around these spots in 30 days, and the name was catchy. It was the right time. He was catching a wave of interest, and it sold like hotcakes. We took the PPM, the pitch deck, we pushed it out and got a lot of interest. It was like WeWork's little brother in that sense, and people could access it at a low rate. They can get involved. I think it was like $25,000 at the time, and they loved it. It was selling fast. It was raising money. He built 12 locations, the guy that owned it, and then suddenly everything changed. Suddenly locations weren't popping up, and very, very quickly that person couldn't be contacted anymore. And then the whole thing fell in like a house of cards. And that was my one and only, but very fatal mistake that I made, where I looked at the project and I believed in the idea and the concept like everybody else did. And then where there were red flags in the management, I kind of like, we're deal makers. We don't necessarily think a deal's going to completely unravel. You might see some red flags here and there, but you think, okay, well, how bad is it going to get really? Like, this is, I hope everything works out fine. And of course it didn't. And then it crashed. And then I even got burnt significantly I actually got charged with a conspiracy to wire fraud at the time, and had to do some time for that. So that sucked. And that's ever since then, my philosophy has been exactly what you say. It's like, yes, the deal looks good. Yes, you might have the right legals. Yes, you might have the right compliance, but who owns it? Who's running it? Because I've been really burnt.
Character matters. Character matters. I'll share another really quick story. So I did an investment property for new investors. Okay. So new investors, but they're real estate agents. They did really well in real estate. And they had been involved in different real estate projects before, but this was the first one where they were the boots on the ground. It started and ended with them. So I went to some of my investors and I was like, look, here's the deal. We have a really good property, but we got character. This is important to these guys, right? They want to build a legacy. They want to build an ancillary income stream. And right now they're just out selling real estate. So to make a living, they got to sell another house, right? So this is kind of the next step for them, right? They know their numbers. They have attention to detail. Take all the way that through, and we go to the very end, and everything went swimmingly. They did the project quickly, on budget. We get to, and we were in an environment where you listed a property on a Friday, you had people through all weekend, and normally by Monday night you were reviewing bids. It was just a super hot market. So this is Friday, and I get a phone call saying, we got water running into the house. It's like somebody turned on a hose.
Okay? Oh my God.
And so it was the house was on the bottom of a hill, and there had been a bunch of rain. So the runoff was coming from beside the house, from the house that's beside them, and evidently they had a underground system coming from the neighbor's house right to their house. They didn't know about, and they wouldn't have known because until it rained, right? So the long story short is they could have thrown their hands up and said, "We don't know what to do. By the way, we've exhausted the budget. We don't have any money left for renovation, right? So it's not like we have money sitting around to do this extra work." They could have thrown their hands up, and they said, "We're going out to the property right now," and they're giving me a play-by-play, right?
So just to interject, so these are real estate agents that have essentially gone from the selling side of things to, hey, we want to do that. We want to go a level deeper or a level higher. And we want to become.
We want to do the projects.
Yes. Okay.
So,
which is the natural trajectory for a lot of those guys.
It is. So the long story short is they get shovels out. They dig up the backyard. They put together this really complex French drain system to divert the water away from the house. They then go in the house, take the rugs up, lift them up, put in a dryer system, clean it. Friday night, and they stayed up all night. Was done, finished. Didn't have to come back for any extra money. They hit the open house on Saturday. We sold for $60,000 over list on Sunday night. And so I get done with that and I'll have conversations with other investors, right? And it's like, sometimes the stuff you're looking at on paper, it doesn't matter, right?
Yeah.
Character. Bad stuff happened. What do? You can throw your hands up in the air and say, poor me, or you can find a way to solve it. And, at the end of the day, it's a little bit esoteric. How do you find that? Some of it, it's not in writing, it's feel. You have to be able to, I believe it's very much a relationship business. You have to figure out a way to be on a commonality with your partners and know them, right? Know,
Well,
what
know they're
makes
going to do
them
what it
tick, what
takes.
motivates them, all that good stuff.
Knowing that they're going to do the right thing, like do what
Right.
it takes to make it right. Because they could have just thrown their hands up right there and said, hey, look, this is botched deal. It hasn't worked
Right.
out. You missed the
And
deadline.
part of that
Everyone
is,
loses money.
let's say you have somebody that's super experienced and they have 50 projects going on. Okay, well, they're calling somebody on this, right? But they have they have 49 other projects.
Yeah.
By the way, if this one doesn't work out, the 49 others are probably going to work out. So yeah, whatever. Law of averages.
Right. Right.
So part of that is you're really trying to put yourself in the shoes of your investor client, of your borrower at that point, who you're investing with, and understand what their mentality is, what their goals are, and really kind of leverage their motivations.
Yeah. And just to clarify for anyone that's listening, when you refer to the borrower, I know some people can get mixed up between who's the investor, who's the borrower is the developer in this case. These are the people who need the money from investors.
A lot of different structures, right?
Yeah.
You'll have some quote unquote borrowers that will say, look, I want a joint venture partner. I want somebody to put up all the money for me, right? That's a little bit of a different structure. A lot of times what investors will look for is they'll say, okay, you don't have any money at risk. So here's what we're going to do. We're going to create a new LLC. I'm putting up the money. I'm going to own 51%. You're going to own 49%. Okay. I'm going to earn a preferred rate of interest on my money while it's out. And then once it's all paid off, I get the money back first, and then we arrange some degree of split of what's left.
And that's only if they put all the money up. If there's a bank involved, then you've got yourself a first lien to contend with. And let's talk about that. Let's talk about because this is what people, I know when there's people thinking about, I want to be a developer. I want to get in, I want to raise money. And they start chopping up a deal. They have an address, they have a plan for it. They start becoming spreadsheet millionaires, right? Start punching those numbers in.
This looks really good.
Yeah, it looks really good. Okay, so then they say, I need to get money. If I can get, 25% in from investors and I can be the master of the money, then the bank will give me a loan to finish off to get the rest of this property. But I'm going to need a surplus too, so that I can do the renovation works on this. Sure. So it's going to have to be, it's not just purely on the property value. It has to be on this like LLC structure where I'm a GP and those are limited partners and they can come in and we can now do this business effectively.
Right.
So when you're now, so again, it all makes sense as you kind of think through it. But then you have different conditions in place where the investors are no longer getting first lien on a property because the bank's in there now. So they're if there's going to be a lien, they're going to get second and on a very small amount. And so then what kind of safeguards could be put in place? Because when people think about real estate, they're thinking of it initially as a safe store of value. But then as soon as you go into development and projects, it's no longer a safe store of value because the money is being used. And it's being deployed.
The catch points there is, so the entity that's going to own the property is an LLC. It could be something else, but let's say it's an LLC. Okay, that LLC, typically the person that put up the money, they will want a majority interest in that LLC. Okay, and the reason why is who put up the money, right? The investor put up the money, right? If things don't go as planned, their recourse is they can now take over the LLC, and now they're responsible for the first deed of trust, but they don't have to answer to the developer any longer.
The GP's gone.
Yes. And if an investor is smart, they would say, look, everyone's bringing something to the table here. I want to give them every opportunity to be successful. But at the end of the day, if they didn't put up any money, then who makes the rules,
Well,
right?
that's the question, because then you have investors that have come in. Let's say you have a multitude of investors. I mean, we're getting into the weeds here, but like this is, if people are thinking about development projects and they're thinking, how can I raise, let's say, $10 million for this $30 million building that they want to pick up?
Right.
And they've got 50 investors. People have come in at as low as 150,000, some 500, some a million or two. So now you've got these different investors with different levels of interest,
Right. Right.
essentially.
Right.
And then so in a situation like that, that's where on the GP's exit, someone's going to have to appoint a manager,
Yes.
because
Yes.
otherwise it's going to be a shit show. You're going to have all these people kind of
Right.
scrapping and fighting. Well,
Right.
I've put in the most amount of money, I should be the ones in charge. And then there's the runner-ups, and then there's the people who put in 150. While it's the lowest, it might be everything that they have. So it's like, how do you weigh all that? And it's always a difficult situation. And I mean, that's a bad situation to be in.
It's
90%.
hard to get people to agree,
Yeah.
right? But
Have you ever been in that?
the right thing is, first of all, they need to agree, and they need to be able to appoint the person that has the best ability to execute if the sponsor cannot, right? So at the end of the day, bad things have happened. What do we do now? Well, you better have somebody that you can appoint that can come in to take over that entity, that's got the skill set to do what's being asked, right? And absent that, look, you're really betting on the sponsor, right? Yeah, and that happens frequently. But as an investor looking at this, you got to look at all aspects and go back to the first rule, which is don't lose money.
Right. Don't lose money. How can we turn this around?
Right.
How can we make this into something, at least break even? Yeah.
Look, if you go into a deal and you got your money back, it's a pretty good day on the street. It's a good story. And
Yeah.
frankly, I will tell that story a lot, where it's like, here's all the bad things that happened and we got our money back. It's not bad, right? I could sit here and tell you about all the great deals we did and all the money we made, and that's great. But let's be realistic and talk about everything that could have gone wrong, went wrong, and we still got our money back.
Yeah. Yeah. That's a good place to be. All you've lost is time at that point. But you've certainly got yourself some experience. You know what to go in next as well.
Yep.
Well,
Yeah,
at
and you're going
least
to be subject to whatever the market is. We've seen, maybe not in the last couple of years, but in that little run up there from like 17 and 18 up through COVID, right?
Yeah.
You saw the benefit of, when time went by, values increased. So, okay, I have an as-is value of this property of what it is when we bought it. I'm now 2 years in. I now have my entitlements in place. I'm ready to start building. Nothing's happened because we had challenges, but the property's worth more. So you may have the same margin, even though you burned through 2 years of time and / expense that comes along with it.
Yeah, the carry costs can be quite high.
There's no question.
And that's the thing about, and that's what killed a lot of people in the business. That's what really put a lot of people out. It's just that they couldn't afford the carry costs, and then you've got repossessions, and you've got investors calling their money back, or everyone in the mix just can't afford to keep it going. I mean, it's why you want to have like investors who have deeper pockets to come in, just in case that ever happened. But
you want to have deep pockets. You also want to have patience, and you want to make the best decision you can based on the situation. I've done a lot of development work in Washington, D.C., and Washington, D.C. is notorious for having a very slow approval process. The regulatory board, typically for approving a new construction project or a repositioning where you're taking a single unit and making it into 7 or 8 units, right? That can be 9 to 12 months to get an approval. So you got to buy the property, and then you are 9 to 12 months before you could put a shovel in the ground. So ideally, you pay cash for it. You don't have a service, right? But expensive real estate, prime locations. A lot of times, people are coming into that with the need to have to service debt during that period of time.
Yeah.
Now, again, values kept going up, so those folks ended up doing just fine. But I have many customers that came back at the end and said, "Okay, I made as much money as I forecast, but I'm never doing that again because I'm exhausted."
Yeah. I mean, let's look at that, because you've got, and there's a lot of reasons why people tend to go for like private investors, because of reasons where if they have debt with a bank, they want that debt furnished every month. You have these obligations. Now, you say you have similar obligations if you structured a deal that way with investors too, but you have the ability to talk to them and say, hey, look, there's an issue here.
Right.
I mean, that's in the case of things going bad, by the way. This is the whole point, is to like not get involved in these situations. But COVID is a pretty much, well, COVID slapped everybody. I mean, I had investments into off airport parking lots, and off airport parking lots. Part of the pitch to get investors to come in on the deal with us was, these airport parking lots are half the price of the airport parking itself. And the last time the airport shut down was, well, it wasn't ever shut down. It was
Right.
always open, right?
Right.
May have been shut down for 4 hours, but that didn't affect the parking.
Right.
And so it was a really good angle. And you'd think that, well, it's anchored certainly to this one big thing, which is an airport. Otherwise, this area is kind of dead land. There's nothing else going on here. But it was like, okay, well, the airport's a pretty good monster there to back. And so, but then suddenly all the airports shut down.
Right. Nobody's traveling.
Within
Nobody
the
needs to
first
park
month,
even at the airport.
Yeah,
The off-airport stuff is certainly not going to be in use.
Completely died out. And it was tragic, because in the first month you had this windfall of cash because everyone came back to collect their car. and then it was like 1 month, 2 months, 3 months, 4, 5, 6, 7, 8, 9 months carry costs, and you're like, hang on a sec, I can't afford this. And the operations die out because they do work on relatively thin margins, but they're normally stable. And they're good real estate platforms. Parking lots in general are. And I know that we had that experience with COVID, and that was a bit of a challenge. Okay, but what makes that's what to do in a situation where like a deal's gone south, and there are macro factors, micro factors that have come into play that have just completely pulled the rug out under your feet, and you just kind of have to just adapt and you sort of flow, go with the flow, and do the right thing. But what about, in terms of like looking at a good deal, looking at something that in a good market, good time, or looking at a deal that can stand the test of time or can weather a storm like COVID, should it be the case? What would you do to like raise money? Like, because it doesn't always come from, we spoke about individuals there, but you did mention debt. Like, how do you structure them when you've done it yourself? Like, how have you gone about like setting up the way in which you'd get the money to get the deal?
So a lot of that is, the beauty is in the eye of the beholder, right? So it is the data that you can present. And then, frankly, what you're doing is evaluating the data and figure out what's the right resource to fund that type of investment. So I would say it starts really two ways. Number one, the sponsor, right? So who is the sponsor group? And you think you have a pitch deck or have enough information you're putting together in a formal plan that says, here are my sponsors, right? Here is what their experience is. What folks want to see is that you have done what you're being asked to do, right? So if you're developing land, okay, we've been developing land since 1986. We've done 3,000, whatever. List those lots that you did, and then be able to show on a subsequent page, here's what the yield was on those lots. Here's what we made. It's important to be able to show relevant experience, right? And experience, it's not the only thing, but certainly I've seen investors get over their skis because they're trying to do something they haven't done before, and they don't know what they don't know yet, right? Because they haven't done it. So probably, character is probably the first thing. The second part is experience. Have they gone through what they're being asked to do? So if I'm putting together a pitch deck or I'm working with investors, I want to sort of focus first on, okay, here's who my partners are. Here's what they've done. Here's their experience profile. There is a financial component to that. Show me what your financial statement looks like. They're going to want to see what your credit looks like. If there's been issues, it can be explained, but you need to address it up front. Here's what we went through. Here's what we did. And I almost, I'm a believer, if you haven't gotten your nose bloodied, you just haven't been in the business long enough. So I would rather have somebody that's been through some stuff and is coming out the back end, because they're a little bit more conservative. They know what can happen, than someone that's on the ascension that doesn't think that anything wrong can ever happen. So that's one of the things I look for. Is
it's like risk mitigation. You're going through your due diligence process to kind of like, what kind of track record do you have?
Yeah.
have you got some scars? Can I see that you've now, you've grown a bit as a developer, perhaps, as a
Yeah.
sponsor? And this is when you're looking to raise capital, right? So this is the investor evaluating the opportunity.
Yeah, and I'm looking really at the sponsor group first. Do they have
Yeah.
enough experience? What's their financial background? Are they what's their current financial position? All of that stuff. So that's kind of point number one, and you're addressing character inside of that. And the second part is the deal. Okay,
Mm.
here's what we're buying the property for. Here's what the overall plan is, and you want to have enough details about the market. I mean, people will look for, is this in an area where there's a lot of new construction, or whatever you're looking to do that's already being done there. People don't like being the first mover, right?
Mm-hmm.
People don't want to be the first development in an area that just hasn't had it. They're looking at employment bases. They're looking at transportation. If there's issues with crime, address it, right? I've had deals in urban areas where the answer was, it's an urban area, people are used to it, right? We had a project that was $2 million project, and we had a shooting on the next street over during the day, right before we went to list. And my initial thought was, holy, who the heck's going to buy a $2 million house a block away from where there's a shooting during the day?
Yeah.
Sold the first weekend. They're used to it.
If it's
like
acceptable, if
Yeah.
it's the norm.
Right.
Yeah.
But so part of that is you have to be able to identify that, and you have to be able to, and counter it. Because if there are real underlying issues with that location, it's better to flesh it out now and address it and figure out, is it a real problem or is it not? And then the second part, and this has to do with the project itself, is there a secondary exit? Is there a different way to get out than what you're planning on? Because, best laid plans, right? So let's say you're doing a for sale condominium project, okay? And the average sales in the area show in that particular zip code, there's 18 sales per month. You're going to be selling 30 units. Here's how many units are forecast to be right. Okay, well, we can look at that and forecast it's going to take 9 months to sell through this. Okay, but what if rates spike like they did a couple years back, and you're going from an environment of 3.5% to 7.5%? What does that do to your buyer pool? All of a sudden, you got a real problem, right? And one of the answers is, okay, we could take a step back and convert this to rentals for now, and keep them as condominiums, and we can rent each one individually. And here's how it's going to cash flow, right? So we've now got the asset built. Most of the risk is vetted out because we now, it's now complete and finished.
So that's like a fail safe, like a contingency. Like, okay,
right.
That's not an exit. That's like saying to the investors, if this happened, we would do this, and this is how you would maintain.
Right. But
you safeguard your interest in the opportunity.
Where it could be an exit is if the value has improved enough, is you can refinance that debt with renters in the property. So in that sense, the investors could get their money back, and they could retain interest ongoing because now they own a rental property. But ideally, look, if you get your money back and you still own an asset, that's a good day.
Yeah.
Right. It's not ideal, right? Because you were forecasting having a big cash event that may not happen. But again, if you're in an environment where rates doubled and the worst that happened to you is you got your money back and you own part of an asset, it's not a bad day.
Yeah. I mean, I do love real estate for that. There are a lot of options that pop up, and normally you can see these problems starting to happen like months in advance.
Yeah.
And so it's kind of like, I always liken like dealing with real estate is like trying to turn a U-boat down a stream. Like you have time to kind of plan and strategize and figure out what to do. You can dwell on it, worry about it, and you can figure it out. You can figure out what to do next because there's normally enough time,
Yep.
So the writings on the wall usually are it's ahead of time. So what's going to happen. That's good. That's what I've always found to be a comforting factor when it comes to real estate. Now, in the case of, debt, I'm not as experienced with the debt side of things.
Yeah.
Whenever I've been involved with capital raises, it's always been through the private investor, i.e. the retail investor in the US, the accredited investor, and offshore. And when I've been raising money for different businesses around Europe, uh, and actually international as well, in terms of China, it's always been like professional or sophisticated investors. It's always been dealing with people who have a tranche of money that they're looking to deploy so that
Sure.
money can work for them. They're
Sure.
not necessarily like, 100 millionaire types people. They're people who have maybe a net worth of $1 million or more, have 250, 500 grand to drop somewhere. In the US, if it could be even moving money from an IRA to self-directed into a property, something that they want some predictable earnings from, that sort of thing. But never with debt. And so with debt, that always seems like this kind of different. And I know you're involved with this, that you're
Mhm.
involved with structuring these sorts of things. Explain how that process works, because I know that you can do deals with a combo where you can structure the deal at the same time as equity and debt, and you can sort of
Yep.
bring these sort of partners together to actually close on an option. Um, have you had experience doing that before?
Yeah. Look, there's a multitude of different options inside of debt, but I'll break it into two different segments, right? Short-term debt. Short-term debt has to do with where the use of the property is going to change, or there's going to be improvement to the property. So think of I'm buying a lot, and then I'm building an apartment building on it. Okay, so what you're buying today is a lot, right? You're going to be building an apartment building, and then after the apartment building is built, now you have a secondary option, right? So you've got the first loan that is for acquisition and construction. Okay, that is typically based on a couple of factors. I mean, experience it goes a long way in that factor, but it is loan to cost, and then secondarily loan to value, loan to ARV. So if I'm lending 10 million bucks, what's the property worth upon completion? And they will normally say, we want to be at 80 to 85% loan to cost. Loan to cost is just that simple, right? I'm buying the land for this. I'm building the project for this, and then here are my soft costs rolled into it, right? So here's my total costs. They're going to want to see the sponsor group, and that could be, GP equity, have 15 to 20% of the total project costs invested.
Yeah.
Okay. And then you're getting a short-term construction loan that goes anywhere from 12 to 24 months to build that building. Okay. You want to make sure that you have options to extend if it goes past 24 months. But candidly, it starts getting expensive. The whole idea on a construction loan is you got to turn off the interest meter as fast as you can. So you got to
Right.
get
It's
the project
accruing.
built,
It's
and you
because
got to get
what is the
people.
normal rates that you're paying? It's normally quite high, right?
Yeah, it's all relative. I mean, look, a 30-year fixed loan on a house that you live in today is about 7%,
Hmm.
right? If you're doing an apartment building, you're probably looking at 9.5 to 11.5%. So
Yeah.
it's more expensive, but it's not 15 or 20%.
Okay. And do you ever deal with like hard money lenders and that sort of
Yeah,
thing?
yeah.
And they're significantly higher.
No, well, so hard money falls into a bunch of different categories, right? So, um, frankly, that industry has become more of a commodity because Wall Street discovered it. Frankly, you had these these hedge funds, these insurance companies, these private equity funds that are looking at what's going on in real estate and saying, okay, we like the debt because we have a secure position. We can analyze what the risk is, and we're getting a better than average coupon. We're getting a yield on our money while it's invested, and we're not into it long term. So we're not betting where our cap rate's going. We're betting, can the sponsor execute, and can they refinance or sell when they get to the end.
So it's
So, and
short.
what I will tell borrowers or sponsorship groups, it's like, look, you might be able to get a lot better interest rate from a bank, okay? But what's the bank going to make you do? The bank's probably going to make you put a whole lot more money down. They're going to want you to put cash in their bank up as deposit, and they're going to look through everything, in your background, tax returns, if typical private money lenders or private equity firms or whatnot. They want to know about you, but they're also not going that granular. It's really more property based.
Yeah. Because you're like, yeah, that's where the money is going to be secured. That's where their risk is going to be reduced. It's on the asset itself. Okay. So you've got, and I know it goes way deeper than that.
Yeah,
I know
like
that's
that's short-term debt, and then upon completion, long-term debt, basically coming from the same source, right? But there are parties out there, insurance companies, right, that want the income stream. So interestingly, on that side, you can get a 30-year fixed loan, right? And there's also options for a 10-year or 7-year, something like that. But they want the income. So they'll give you right now 30-year fixed loans on multifamily properties run in the lower sevens. Okay. But it comes with a 5-year prepay penalty. So they want the income for 5 years at least. Okay.
Mm.
And if you paid off the loan inside of 5 years, there's a prepayment penalty that descends. So it's 5% the first year, 4% the second, 3% the third, and on down. So after the 5th year, there's no prepayment penalty. But so you have to think about that. If I want a long-term loan and I want the best rate, I'm sort of locked into this for 5 years, unless I can live with a big prepayment penalty, which makes no sense. It just
right.
makes no sense.
So you got to be happy and content with that structure for 5 years at the very least. I mean,
Yes.
it's good. So let's go back to that condominium example. Like you have this thing, you've got some good exit clauses, you have some good, so plan A, plan B, plan C. You know what you're going to do if there's ever if there's ever problems with it. You can rent it, you can refinance it. These are options to an investor, right? Or to even to a financier, like a lender. But ultimately, to actually do the deal, so we're still on the spreadsheet. To do the deal, we're thinking, okay, so this is how I can structure it. This is how I can set it up. How, well, you still need that money to come in with initially, the
Yep.
equity.
Yep.
Debts, we can always talk about debt, but they're going to say, oh, well, how much did you put in?
Right.
How much is in already? Have you taken it off market? What have you done? And so how much money have you put in the deal? And if you don't have the money and you have a smidgen of money and you're using it for the operations of actually going through the purchase of the property, so you're maybe paying for some legal fees, you're demonstrating some payments, but you haven't got any significant sum in the actual thing itself. Then you're looking at investors, you're looking for equity partners.
Yes.
And so, and that deal, despite how good it may be with the bank, with the lender, doesn't matter if you don't have that equity because they're not going to give it to you. So that's where a lot of people fall over. They get to that point and then they just can't raise it. They just don't know how to do it. So in your situations, when you've been there, have you always sort of tapped into a network that you already knew, or have you ever had to kind of go beyond that and find other people? Like, how have you gone about securing the equity proportion of these deals?
So I will say, I'll give you what my experience has been. In every market, there's a network, right? And it's a matter of
Network?
a network of people, right?
Yeah.
It's a matter of managing that network and knowing who does what where, right? And you'll probably find, I'll give you Washington, D.C., there's about 5 to 7 family offices, high net worth individuals or families. Some cases, it's now a fund that's being managed because they've made enough money that would do those kinds of loans, right? And so in that case, the challenge is good and bad. You got one throat to choke, right? Yeah, you have one investor you have to answer to. Bad news is they're the big dog in the room, right? They are going to make the rules because it's their money.
And
Right?
that deal is going to be very favorable to them, not you.
Yes.
You might have gone in there thinking you can do 80-20 on the upside, on the uplift of the property. And then suddenly you're looking at 5%.
Yeah, it's 80-20, all right. Yeah, it's
Yeah.
80-20. It's just not in your favor, right?
Yeah.
So the other side is, okay, you need to raise $2 million. Let's find 20 investors at 100 grand each. Okay. Beneficial for the sponsor, for the developer, in that they maintain more control. Okay. That creates its own set of challenges. Now you have 20 interested parties in what's going on at your job site, on what's your cost of drywall, what are you doing for flooring, what are your finishes. You have 20 different groups to answer to. And by the way, it's not only them, it's their relatives, it's
Whoever's
it's
whispering in their ear.
right.
Yeah.
There's a lot of different moving pieces and parts.
And these are people that you would consider as your retail but accredited investors, people you think that wouldn't be on your shoulders, but they are. I always say when you're taking on investors, it's kind of like taking on new family members. You got to
Yep.
invite them to the weddings and the funerals, whether you like them or not.
Yep.
And they're going to
No,
be there, and they're going to share their peace of mind with you if they have something
no,
to say.
no question. And look, let's say you have 20 investors, right? They only need to have one to make a lot of noise to make your life
Yeah,
a challenge, right? So that's kind of the hardest part is now you're dealing with 20 different personality sets and you're managing 20 new family members. And that's challenging. The benefits are you maintain more control over your deal.
it's a trade-off.
It's a
Do you
trade-off.
go for the one family office, which, by the way, you say network, right? It's hard to get access to family offices. It's like
There's no question.
plenty of
There-
doors that you've got to go through and hands you've got to
you
shake.
can't get a return phone call.
Yeah,
So the whole thing is you want to understand what their criteria is, and you want to bring them exactly what they're looking for. And if you do 2 or 3 deals with them, now they know you, you know them. They're going to answer your phone call. But the first time is always the hardest.
it is. It is really
And
hard.
there's not an easy solution for that. That's just the way the world.
That is literally the definition of you got to go and start networking. You got to go out and start. It's not just about prospecting and peppering them with an email in there. If they have some of these, they have like a website. You don't just farm. You got to find them, find out who knows
They're
them.
not going to call you back.
Yeah, you got to. You need to get into their groups. It's difficult. It is difficult. But then so that's why a lot of people then default to, okay, I've got to raise money from the retail investor, the accredited investor, and find 50 plus people to come in on a deal with me. And you look at contracts and you'll look at like sort of like GP and like LP management agreements where you're looking at, well, these investors can come in, but they don't have any right to any say really on what the manager does. You can have as much language as you want in the contracts, but that has to be enforced. Initially, if there's ever, and this is what I'm saying this because people might think that, oh, they can circumvent that with contracts. Well, yes, there might be a contract in place, but if an investor has a problem, they're going to speak up. If they're concerned about you and your permits taking far too long to get approved, and why you haven't dealt with the asbestos issue in the roof or whatever it is, like they're certainly gonna make themselves known. And the worst case scenario is when they start making themselves known to the other investors involved.
Well, you can expect that to happen.
Yeah, and a lot of people, like initially a long time ago, it used to be kind of siloed. You'd have individual interactions with each investor, but nowadays, and then you'd have maybe the one convention if you had like if your business was big and you would invite all your investors around to a location to discuss things with them. But nowadays, a lot of the time, businesses are doing these sort of Zooms, these webinar style things where investors can all congregate in an online setting just like this and hear the updates from the sponsor and details and so on and so forth. But in doing so, they have access to each other.
Yep.
And you can be sure to know that they've written down everybody else's name that was in the attendee list.
There's no question.
And so you're going to have to deal with that, and that's part of the job. And it is difficult, but a lot of people end up having to go that direction because the family office is far and few between. The accessibility is
Well, they lose control.
high. Yeah.
If you're dealing with one investor, they're going to make the rules. If you're dealing with 20, well, now you can dictate rules a little bit. But other challenge being, look, if you need $2 million to do that deal and you get 19 investors at whatever, at $50,000 each, well, you don't have enough money yet. You need the 20th. So you need all the money to do the deal.
It needs to all go into one pot.
Right.
You got to do each deal one at a time.
Right.
You got to get it all in. You've got your business plan. The deal with the financier, the debt that you're looking at you don't want that to expire.
Right.
So you're kind of working. You're kind of juggling these deadlines.
Well, yeah, and you've got real property issues. I have a property under contract. It's due to close. March the 31st. I have to have all the money wired into my account prior to, so I can in turn wire it to closing. And your guy that committed for 200 grand, he's skiing. Well, you can't do it that week. What do you do?
Or the other guy who, I'll invest 350 grand, or I'll invest 750, but I just got to wait until my house sells or something.
Yeah, right.
Yeah, and it's difficult because you're on their timeline, they're not on yours. So that's the question. It's like if we're bringing this from like structuring a deal, evaluating the safety points on the deal, looking at what options there, combination of debt and equity, and now we're looking at equity, and it's like, okay, how then do we get equity in quickly enough? do you just kind of spend a long time cultivating relationships with retail investors, getting, promises, essentially, people to commit, pledge that they will get involved in a deal with you, and then eventually then structure the deal to have that money drop in, hopefully in a quick windfall? Or do you have a mechanism for which you use to raise the money fast? Which is essentially selling. It's reaching out to people that you do know or you don't
Yep.
know and asking them to put money into this tin cup of yours.
Yep.
Do you have any thoughts of like have you done that before? Have you
Well,
ever?
here's what I've seen that's worked, and it takes time, right? It takes time and it takes history. I had an investor that I worked with for a long time that raised money for a fund, and he would do individual projects. He's like, okay, I need to raise $3 million for this particular fund, right? And he'd reach out to his network, and he'd have some folks that didn't respond for a while, and then said, hey, I'm good for $500,000. Well, it was like, sorry, too late. I have this huge network. If you don't answer right away, it's already committed. But he's like, well, here's what I will do is we have a velvet rope here, right? The velvet rope is up now because we have all the money we need. The next time that we need money, I'll put you at the top of our list. But, so he had enough leverage because he'd done enough deals and he had enough of a track record where now he could put the onus back on the investors he was raising money from, saying, if you want to participate, you got to be front and center
Yeah,
because
you can really instill a
time is
sense of
the enemy of all
urgency that way.
deals. So, and you'll find out awful quick. And what he had to his benefit was, if he was going to put 20 people in a deal, well, he had 2,000 investors. So, how far did he have to get to reach enough money? How far did he have to get into his book?
Right.
But that takes time, and it also took credibility where he'd done hundreds of deals before and it always performed.
Right. So you have to have the track record to be able to be able to effectively instill a sense of urgency in that way.
Right.
Are there any other ways to do it if you don't have the track record? For the young, let's say someone who's listening to this is one of those real estate guys.
Right.
Got a couple of real estate buddies. They know how to sell to buyers. Now they want to get involved with development. They don't have the money. They have enough money to kind of secure a deal, put some good faith money down. They now need to go ahead and start raising. They've structured it correctly. Maybe it's a Regulation D 506C. They can generally solicit, so they can go market. How do they build up the urgency? Is it like just luck, or do they have to have a mechanism?
I think you have to start relatively small. So your first deal out of the chute, you're not doing 5 projects and you're not looking for $5 million, right? You're starting with something that's reasonable because you've got to be able to build a track record. And that track record starts with the first mover, right? If you do right by your investors, the words travel fast. You guys are all in the same circle, right? If you've got a business owner that has plenty of money and they're like, yeah, I'll put 50 grand into this and see how it goes. Well, if it goes well, he doesn't have just 50 grand.
Yeah,
But the answer is something has to go well, right?
So the investors will have more. If they're coming in at 100, they have more. Typically.
Right. They're at their country club. They're talking to their butt. I mean, but it starts with the first deal, and the first deal has to come off well. You have to perform and execute with what you said you were going to do. And, even down to the timing and the budget and the communication, all those things are hard, but it's the business we've chosen, right? That's the name of the game.
Yeah, I agree with you. Start small, not thinking small-minded, just start small, something that you can deal with. Raise the money that you need. I mean, maybe 50 grand at the most, or 100 grand at the most to do a deal with your own
Sometimes that
money.
first deal is friends and family. It is.
Yeah.
They trust
Get
you.
in,
They
show
know
the
you.
win.
Hey, Aunt Marge's got 10 grand. Okay, we'll go find, go talk to all your aunts and uncles and cousins and whatever, and put enough together to do your first deal, and then you come back and do the second one.
That's
and
right.
I'll have a number of builders that will have a friends and family fund. They're like, look, we constantly keep $2 million laying around for projects because stuff crops up.
Yeah.
And what they will tell me is they're like, look, we pay a preferred return, and a lot of times we'll let people know we got their money back. Here's the bank account. Here's a snapshot. We're going to continue to pay you interest on it because if we give you your money back, we may not be able to get it back again,
Yeah.
right? It's fully disclosed, it's discussed, but it's a strategic initiative by the builder where they're going to say, it took us so long to raise this money that we don't want to just give it back and then have to worry about going to raise it again. It's far easier to continue to raise money. It's just inertia,
Yeah.
things that are in motion have a tendency to stay in motion, right? Then starting from a dead stop and saying, okay, now I have a deal. I need to raise money and I got to do it in 30 days.
That's right. I mean, that's a surefire way to do it properly. I do think that that's a great way to do it. I think that there are other people out there that don't have access to the friends and family, that don't have those circles around them, that still want to get involved, that have gone through the learning process, have their, the belief system is, is that they want to create this kind of life for themselves. They want to become a real estate tycoon. But how do they get started? I think the only other way that you can navigate that, if you don't have friends and family, if you can't start small with people that you know, well, aside from getting to know those people through jobs, through your own personal networks, is to then you could essentially still market the deal, but you really have to focus on the deal itself. The deal has to be an instant win. It has to be something that's
Right.
so
Right.
so safe, so predictable that no one would bat an eyelid putting money into that thing.
Right. Right. And I would present it,
And the onus is off you. It's
right.
on the
I
deal.
would present it as here's the multitude of exit strategies we have, right? If here's what the goal is. If this doesn't happen, we're gonna pivot and do B. If that doesn't work, we're gonna do C.
Yeah.
And in any case, the yield curve is different, right? We make a lot more money if our original proposal goes through, but if it doesn't, look, C may be investors, you get your money back. You didn't make any yield, but you get your money back. It's not what people want to hear, but it's honest and people will appreciate the candidness of saying, look, this is a worst case scenario. You got all your money back.
Yeah. That's very good. All right, Chip. Let me ask you this before, as one of our sort of last remaining questions, because we're getting close to that time. What kind of stuff are you into now? You still very much involved with structuring these deals? You have options available? You getting involved in any more?
Yeah, we doing mostly new construction for home builders. So one of the things that's happened is, on a national basis, the Fed regulates all these banks, right? And they look at the amount of commercial loans that banks have on their balance sheets, right? And they put home building in the same bucket as a commercial office building. Well, if you're following the commercial office space, particularly since COVID, it's undergone a lot of challenges. So what regulators are doing is they're putting the screws to a lot of these regional banks, and where a mid-sized home builder used to just be able to go to their community bank and borrow money to build spec projects, they can't get the money anymore. So
Oh, wow.
what we will do is we'll come in and say, look, we're going to make it easier for you. Look, it might cost you more than if you were dealing with your regional bank, but let's be candid, you can't do that anymore, right?
Mhm.
So we're going to structure it in a way where you're going to put less money in, right? And folks are interested in, what's my ROI? How much money do I have to put up? What am I going to make,
Mhm.
right? And we're
That's the investor's number
enhancing.
one question, whether it's a
Yeah,
bank or people. It's like, if I park $5 with you today, can I come back next week and pick up 10? That's the
yeah, that's it.
yeah.
And nothing else really matters. The actual, I used to, I worked for a fund for a while, and we were more expensive than the rest of the industry, but we could do more creative stuff. And I would, simply sit down and write out, I'm okay, if you go with lender A, they're going to be cheaper, but you got to put up 100 grand and you're going to make 30 grand on it. So, okay, not bad. You made 30% on your money over a year. If you went in our direction, okay, you're making the same 30,000 bucks, but you only had to put up 60,000. So you put up 60 and you made 30, you made a 50% return. So your yield just went up by almost 70% over what you would have made. And by the way, you're actually paying more for it, but you know, I would always reverse it and say, I tell you what, why don't I do the deal and let you do the loan for me? Because I'm making more money that way, right? Doesn't that seem to make more sense? So, when the light bulb goes off and people understand, look, it's not about the cost of the funds, it's about what am I making with the money, then it just becomes a lot clearer path.
Right. And when you're giving when you're giving people access to this, are you sort of doing it in the capacity of a broker, or are you kind of in front of a fund or a syndicate of
No,
people?
it's with typically insurance money or private equity funds
Oh,
that
I
I work
see.
with. Yeah.
Okay. And you're able to structure those deals. So if anyone's got something good that's on the table and they're kind of muddling through, give you a call. What's the way people can get in touch with you? Do you have a
Um,
website?
let me. So cell phone is 703. This is US. So one
So
seven
plus
zero
one,
three
yeah.
six
Seven.
zero nine 7616.
One more time.
703 609 7616.
All right. Okay. So people want to get involved with you on that front, then certainly give Chip a call. Chip, it's been really good. Thank you, man. Appreciate you taking the
I
time to
appreciate the
go through all
conversation. It's a
that.
lot of fun.
Yeah, I'd like to, do it again sometimes. I'm still learning about the debt side of things.
Yep.
There's a lot to be learned there. There's a lot to be, that's one area I've stayed clear of because it's just finding a retail investor in the US is not that different from finding a retail investor in London, in France, in Germany, in any other country around the world. But dealing with banks and lending options, that's very different. And the
Yep.
laws that surround those things is just incredibly complex, especially when you're going through different borders. And so I've
Yep.
always kind of just like, okay, put my hands up, steer clear. But I've always wanted to know more. So maybe we can probably look at maybe a case study option and really break down all the different ways we could chop it up with debt, because that's something certainly I want to learn. And I know a lot of
Yep.
people out there are in the same shoes as I am because it
Yep.
is complex and it's
Yep.
hard to do.
Nothing easy about it, but look, it's lucrative, on all sides of the equation. There's money to be made. Um, I mean, some of the things that you look at some of these different marketing engines. It drives me crazy when they oversimplify it because it's not easy.
It
It's a
doesn't look
lot.
easy.
There's a lot
Yeah.
of different moving pieces and parts. You are kind of as good as your reputation is. So, and that comes from both sides. This comes from a lender perspective. Can you actually execute? And it comes from a borrower perspective of you've got to have a borrower that knows enough about what they're doing and can demonstrate the confidence that they can perform the tasks that they need to perform.
Yeah, there's a rigorous due diligence period, and it's not
Yeah,
going to be money that comes to you instantly. You have a
right,
lot of work to do to get that money, and a lot of things to prove and demonstrate. Sometimes it is easier just getting money off a retail investor because you haven't got all your ducks in a row.
right, right.
Um, and people do that. I know
And
that.
that happens, right? It happens, and the answer is as long as you execute, you can keep doing that.
Yeah,
Challenge is if you hit a speed bump, now all of a sudden those retail investors are not at your disposal anymore.
exactly. All right, very good, Chip.
All right,
Appreciate your time.
all right. Talk to you soon. Thanks.